At the peak of the dot-com boom, one Canadian company represented more than one-third of the entire Toronto Stock Exchange. It was bigger than the banks, bigger than the energy giants, and its name was Nortel Networks. At its height, Nortel's market value reached nearly $400 billion. Canadians believed it would dominate the future of technology. Everyone wanted in, from pension funds to everyday RSP investors. Then, in a matter of months, it was gone. Over $300 billion of Canadian wealth evaporated almost overnight, wiping out decades of savings and confidence in our markets. But here's the part no one talks about. The real tragedy wasn't just Nortel's collapse. It's that most investors never learned the lesson. Because even today, more than 20 years later, Canadians are still making the same mistakes that caused that loss in the first place. Different stocks, different sectors, same human behavior. Hey there, I'm David Drummond, founding partner at DLD Financial Group. I'm a certified financial planner and started in the industry in 1999. I'm very excited to share this video with you as it brings me back to my first years in the industry. When you're new in financial services, you're often full of ambition and have goals to be the best you can, spending endless hours learning as much as you can cram into your head, which is full of so much new information already. As I approach my 27 years as a financial planner, I've come to realize that the experience of consistently following markets and economies brings experience and knowledge that can only come with time. And what I want to share today isn't just history, it's a wake-up call. Because Nortel's story wasn't just about one company's downfall. It was a mirror reflecting how we think about risk, growth, and greed. If you find this kind of insight valuable, please make sure to like, subscribe, and leave a comment. And if you'd like to see how your own portfolio would hold up in a market downturn, feel free to book a free strategy call using the link in the description below. Let's get into it. Part 1. The rise and fall of Nortel. The cautionary tale. In the late 90s, Nortel Networks was Canada's crown jewel, a global leader in telecommunications. It employed over 90,000 people worldwide, accounted for more than 35% of the TSX, and was held in almost every Canadian investment fund. If you had a diversified Canadian portfolio, you owned Nortel. Investors felt invincible. The internet was booming. The future was wireless, and Nortel seemed unstoppable. But as the tech bubble inflated, valuations soared far above reality. Then almost overnight, it burst. From 2000 to 2002, Nortel's stock price plummeted by over 95%. The company went from being Canada's largest corporation to bankruptcy. The ripple effect was enormous. Teachers, pensions, RSPs, investment funds, they were all hit. Some Canadians lost half of their portfolios without even realizing they were overexposed. It wasn't just an investment collapse, it was a collapse of trust. Part 2, the story most Canadians never heard. Here's what most people don't realize. Nortel's fall wasn't just about bad management or market euphoria. It was also about espionage. In the early 2000s, Nortel's internal systems were hacked. The Chinese state-linked actors gained access to the company's most confidential data, R&D blueprints, strategic plans, and product designs. According to a report from the Globe and Mail, the Canadian Security Intelligence Service, or CSIS, first completed a threat assessment on Nortel in the 1990s, determining that it was China's top corporate espionage target. At the same time, a small Chinese telecom company called Huawei began to rise, using eerily similar technology. Over the next decade, Huawei would dominate the global telecom market, while Nortel's research and intellectual property, once Canada's most valuable technological assets, vanished. The estimated loss? Over $21 billion in capital value tied directly to that intellectual property theft. And while Nortel Networks were watching their investments disappear, Huawei was rapidly scaling, fueled in part by stolen innovation. That's a story no one in Canada likes to talk about, because it wasn't just a corporate failure, it was a national one. A painful reminder that innovation without protection and investing without diversification both lead to the same place: loss. Part 3. The lesson no one learned. Concentration risk. So what was the core mistake? It wasn't just bad luck. It was overconcentration. Too much wealth tied to a single company, a single idea, a single theme. And here's the uncomfortable truth. Most Canadians are still doing it today. Back then, it was Nortel. Today, maybe it's the big five tech stocks, or maybe real estate, or private equity funds that promise stable returns. A few firms that have lost their shirt in real estate are now promoting alts, or alternative strategies, to keep their clients after years of overexposure to real estate. It's a real shame when institutional managers chase returns in order to simplify appeal to the masses. The problem isn't the asset, it's the belief that it can't fail. Because when one company or one sector dominates your portfolio, you're no longer investing, you're gambling. And as we saw with Nortel, that gamble can erase a lifetime of savings in months. Diversification isn't about being fancy or complicated. It's about making sure no single mistake can ruin your entire retirement. Part 4. The modern parallel. Overconfidence in safe investments. After Nortel, many Canadians swore off the stock market and piled into real estate instead. It felt safer, tangible, predictable. And for years that worked. Home prices soared, interest rates dropped, and Canadians started believing property values could only go one way, up. Sound familiar? We've seen this movie before. Different asset class, same overconfidence. Now, as interest rates have risen, many Canadians are realizing that paper wealth isn't real wealth, not until it can produce reliable income. And that's the same lesson Nortel investors learned too late. If your wealth isn't defined by the number on your statement, it's defined by how resilient your plan is when things change. And that's the same lesson Nortel investors learned too late. Your wealth isn't defined by the number on your statement. It's defined by how resilient your plan is when things change. Part 5. What the $300 billion loss really cost Canadians. When Nortel collapsed, it wasn't just stock prices that fell, it was confidence. Entire generations lost faith in investing. Many Canadians cashed out at the bottom, swore off equities, and parked their money in GICs and savings accounts for years. And that decision, driven by fear, quietly cost them even more money. Because when markets recovered, their portfolios didn't. They crystallized their losses and they missed out on one of the strongest growth decades in Canadian market history, simply because they let fear dictate their strategy. Avoiding risk completely feels safe, but it's actually one of the most expensive decisions you can make. Part 6. What smart investors did differently. The investors who survived Nortel and came out stronger didn't predict the crash. They didn't have insider information. They simply followed structure and discipline. They diversified across sectors, countries, and asset classes. They rebalanced when certain holdings grew too large, and they focused on income and longevity, not just growth. That's what long-term wealth really is. Not reacting to markets, but managing them. Part 7, the hidden risk in today's markets. Fast forward to today, and you can feel the same euphoria building. Stock tips from your Uber driver, for example, investors chasing AI stocks, piling into private markets, or banking on continued real estate appreciation. But history doesn't repeat itself. It rhymes, and every generation seems to believe this time is different. But truth is, there will always be another Nortel. It might not be a tech company next time. It could be an asset class, an investment fund, or even a market trend that everyone assumes is bulletproof. But the outcome is the same. Those without a plan lose the most. Part 8. The real lesson. Protect, diversify, and plan for the unseen. The $300 billion that vanished and the $21 billion in stolen intellectual capital weren't just numbers. They were a reflection of human behavior. Greed during the good times, panic during the bad, and a lack of strategy in between. You can't predict the next market event, but you can prepare for it. That means diversifying properly across sectors and geographies, balancing your risk between growth and income, rebalancing regularly so one position never dominates, and most importantly, building a tax-smart income plan that works no matter what the markets do next. Because wealth isn't built by chasing trends, it's built by avoiding big mistakes. Part 9. The silver lining, the opportunity for Canadian investors that was created by the Nortel fiasco. So beyond the lessons we all learned from Nortel about diversification, there's actually a silver lining most Canadians don't know about. After Nortel's collapse, one of the firms that held a large position in that stock kept its corporate structure intact. And years later, in 2020, that same structure was revived to build a world-class global equity portfolio. Now, here's why this matters. That structure still carries nearly $1 billion in capital losses, which can be used to offset gains indefinitely. For investors, that means the portfolio can generate strong long-term growth while keeping distributions largely tax efficient or even tax-free in cases. It's a powerful advantage, especially if you're investing through a corporation, a non-registered account, or in trust for a minor. If you'd like to see how this strategy could fit within your overall plan, including the portfolio's history of taxable versus non-taxable distributions, I've included a link below where you can book a time with me directly. Let's walk through the details together and see if this structure makes sense for your situation. Part 10, the bottom line. What history teaches us about wealth? If you take one thing away from this, let it be this. The Canadians who lost money in Nortel didn't fail because they invested. They failed because they invested without a plan. Numerous clients of mine at the time had self-directed portfolios with nothing but Nortel in it. A structured plan protects you not only from market crashes, but from emotional decisions that destroy compounding. There will always be another boom, and there will always be another bust. But with the right strategy, your retirement doesn't have to ride that roller coaster. Let's recap the lessons from the $300 billion that vanished. Concentration kills wealth. Diversification is your best defense. Overconfidence is timeless and dangerous. Avoiding risk is also risky. A strong plan beats perfect timing. The next Nortel moment won't look the same, but it will happen again. And if your wealth plan isn't built to withstand it, decades of savings could disappear faster than you think. So before the next cycle begins, take a moment to stress test your plan. How would your income taxes and investments hold up if markets drop 30% tomorrow? If you don't know, it's time to find out. Click the link in the description below to book a free consultation with our team at DLD Financial Group. We'll help you build a retirement strategy that's built to last, not just perform when things are easy. Because true wealth isn't about chasing what's hot. It's about protecting what you've already built. Thanks for watching. I'm David Drummond. See you in the next video.